All right, hi everyone. So you're looking at buying a rental property or you already have one. Great. But here's one of the biggest, most important decisions you'll need to make right from the beginning. A decision that will shape your entire investing life. Are you going to hold that property in your own personal name, or are you going to form an LLC to hold it? This isn't just some boring paperwork question. This choice fundamentally determines your risk exposure, how much administrative work you'll have, and even how you'll finance the property. Stick with me, and by the end of this, you'll know exactly which path is the right one for your specific situation. So, let's break down the core trade-off, because that's really what this entire decision boils down to. On the one hand, you've got personal ownership. This is the simplest approach. You just buy the property in your own name, like you would with your own home. Easy. There's basically no setup cost, and easy to manage. But, and it's a big but, the risk is that you've got total exposure. All of your personal assets are exposed if there's an issue with that rental property. Next, you have the LLC structure. This is the official legal structure you create with your state. Its main purpose is to create a legal separation between your personal financial life and your rental real estate business. The best benefit? It provides what's called statutory limited liability protection. In simple terms, it's designed to keep your personal assets, your house, your personal savings, your kids' college fund, safe from any lawsuit or debts of the rental business. So the trade-off is simple: protection versus risk. The LLC offers protection, but with complexity. Personal name is simple, but with tremendous risk. Let's get a little more detailed and compare them side by side on some key areas. First, and most importantly, personal asset protection. With a personal name, you have none. If you are sued by a tenant and they obtain a big judgment, they can come after your personal bank account, your car, even your house. With an LLC, your protection is solid. Your personal assets are generally protected. The lawsuit is contained within the business. Second, setup and complexity. Personal name is simple and immediate. LLCs require state filing, an operating agreement, separate bank accounts, so there's definitely more complexity. Third, costs. Personal name has minimal to zero startup costs and no annual state fees. An LLC has state filing fees, annual or biennial maintenance fees, and you'll likely need to pay for a registered agent. And fourth, financing access. This is a big one. With a personal name, you can get the best home loans with great rates. With an LLC, you typically have to use commercial loans or specialty financing, which can be more expensive, and you run into this thing called a due-on-sale risk, which we'll talk about in a minute. Now, let's delve a little more into why somebody would choose personal ownership despite the risk. The reason is simplicity. There's no formal filing. You don't have to file anything with the state in order to get going. No startup fees and no annual reports or state fees to worry about. You also get the best possible financing terms. I mean conventional 30-year mortgages with low fixed interest rates. This, naturally, translates into lower monthly payments, which maximizes your cash flow from the start. And tax reporting couldn't be simpler. You just take your rental income and expenses and insert them all on Schedule E of your individual 1040 tax return. No need for separate business tax returns. This low-hassle scenario is why it's so appealing for a first-time investor or someone who has just one lower-value property. But here's the thing you absolutely can't ignore. That simplicity comes with a catastrophic risk. If you own a property in your individual name, you are what's called a sole proprietorship. You and your rental business are, as far as the law is concerned, one in the same. Your finances are completely entangled. So any legal problem, a tenant slips and falls, a guest gets injured, a contractor sues you, any of that exposes your entire personal net worth. A creditor or a plaintiff in a lawsuit can legally go after your personal savings, your investment accounts, and the equity you've built up in your own home. And the other way around. If you are personally sued for something that has absolutely nothing to do with the property, a car accident, for instance, the individual who sues you might be able to come after and take your rental property to satisfy that judgment. There is no wall. There is no separation. You and your company are the same. And the detriments don't stop at liability. That same simplicity can also hurt you tax-wise. While individual ownership will not obligate you to keep separate records, sound tax planning often will. To qualify for some major tax benefits, like the huge qualified business income deduction, which enables you to deduct up to 20% of your rental income, the IRS requires you to show that you're running a real business. That is, maintaining separate books and records. But because the personal ownership is so informal, it has a tendency to lead to commingling funds. You pay a repair from your own personal checking account, you put rent in the same account that you put groceries in. It gets messy. If the IRS comes knocking on your door, if you can't clearly show which expenses are for the rental, they can disallow your deductions and impose penalties. So the very thing that makes personal ownership easy, the lack of paperwork, can wind up preventing you from realizing your maximum tax benefits and even get you into trouble. Okay, so let's shift gears and talk about the solution, the LLC shield. The magic of an LLC is that it creates a separate legal identity. It's sort of like creating a new legal person that takes title to the property. You can own the LLC, but you're legally separated from the LLC. This establishes a legal separation between your personal finances and your rental enterprise. In the event that the LLC, which owns the property, is sued or is unable to settle a debt, the legal claims are generally only against the assets held in the LLC. So the property itself, along with any money in its bank account. Your personal assets, your home, your personal bank accounts, your other investments are on the safe side of that wall. They are safe. A creditor who is fighting a struggling rental business can only go after what the LLC owns. They can't go after your personal wealth. Now, this is very important. Legal protection is not something that is automatic. It is not a set it and forget it type of thing. You have to maintain what is called the corporate veil. You see, if you do not treat the LLC as a separate entity, a judge can pierce the corporate veil and hold you personally liable anyway, pretty much destroying the reason you set it up in the first place. This is a huge risk for single-member LLCs. The number one way that people get this wrong is by commingling funds, using the LLC bank account as their own personal piggy bank. You have to respect the separation, or the legal system won't respect it for you. So how do you get that corporate veil to stay strong? You have 3 basic tasks. First, and most common mistake, you must have a separate business bank account for the LLC. All rental income is deposited into this account, and all property expenses are paid from this account. No exceptions. Second, you need formal documentation. This means having an LLC operating agreement, even if you are a single-member LLC. This means signing all contracts and leases in the LLC's name, not your own name, and this means maintaining detailed business records. And third, you have to keep the LLC in good standing with the state. That means you have to file your annual reports on time and pay all of the state fees required. If you don't, then the state can dissolve your LLC and you lose all of that liability protection immediately. All of that protection, of course, comes with a price. You have to pay for administrative overhead. You've got state annual fees, which vary all over the map. Delaware might cost you $300 a year, and Michigan is only $25. You have to have a registered agent, a legal requirement, and that will cost you $100 to $300 a year. And you might want professional help for setup and tax filing. Here's a sneaky tip. Very low fee states can be a trap. When you're only paying $25 a year, it's too easy to get lax and treat the LLC like it's no big deal. You might get lazy on those critical steps like keeping separate books. And if you do, you're pretty much as exposed as a sole owner, despite having gone to the trouble of creating the entity. The cost is low, but the work is significant. Some good tax news. Both LLCs and individual ownership generally have so-called pass-through taxation. This is a significant advantage. It means the business itself doesn't pay federal income tax. Your rental property's profit or loss passes through to your personal tax return, and you're taxed at your personal income tax rate. This avoids the double taxation that happens with C corporations. where the corporation is taxed on its profits. And then you're taxed again when the profits are distributed to you in the form of dividends. With both personal name and LLCs, the rental income is only taxed once. And you can still deduct all your business expenses, like maintenance, repairs, interest, and depreciation. One of the basic tax concepts you need to understand is how your rental income is classified. For most landlords, the IRS considers rental income passive, and that is good. The main benefit is that the passive income is not subject to self-employment taxation. That is the extra 15.3% tax for Social Security and Medicare that self-employed individuals pay. You don't have to pay that. Now, there is an exception if you're a real estate professional. This is a special IRS status where you have to devote more than half your working hours and at least 750 hours annually to your real estate activities. If you do qualify, your rental income becomes active. The catch is, you now owe that self-employment tax. But the great benefit is that you're able to use rental losses to offset other income, like your W-2 income from employment. It's a huge benefit, but it has a cost. Let's talk about one of the best tax deductions we have, the Qualified Business Income or QBI Deduction. It lets you deduct up to 20% of your net rental income. That's a tremendous deal. Qualifying is tough though, because the IRS routinely treats rental as a passive investment instead of an active business. To qualify for the safe harbor, you'll need to show that you're operating a real business. You must maintain separate books and records. You must perform at least 250 hours of rental services annually. You must keep a record of that time in detail, like a time diary, and you are required to include a statement with your tax return. And here's the beautiful synergy. The same actions you take to preserve your LLC's legal veil, the separate bank account, the conscientious record keeping, are the same actions you need to take to qualify for this 20% tax deduction. The LLC entity doesn't just protect you, it sets you up for massive tax optimization. Okay, let's deal with the worst aggravation with getting an LLC in position: financing. The best loans for cash flow are conventional home mortgages. They have low interest rates and 30-year terms. But nearly all such loans have a due on sale clause buried in the fine print. This provision says that if you sell or transfer the property, the lender may demand that the entire loan balance be paid off immediately. And here's the problem. Transferring the property out of your own name into your newly formed LLC is, in effect, a change of ownership. So you may trigger this clause just by trying to protect yourself. This leaves many investors in an uncomfortable quandary. Do without the LLC protection until the mortgage is paid off, or use more expensive financing right up front. So what do you do if you want the protection, but you have a great residential loan? First, and most conservatively, you can request your lender in writing for permission. Be truthful and inform them you're placing it into an LLC for liability purposes and that you'll continue to make the payments. Sometimes, all you need to do is ask. Second, you can issue a personal guarantee. This is where you tell the lender, hey, even though the LLC now owns the property, I personally guarantee to make the mortgage payments. This makes the lender feel more secure. And a third option, but not an LLC, is to deed the property into a revocable living trust. Federal law largely exempts this kind of transfer from triggering the due on sale clause. It does give you some estate planning benefits, however, but not the same level of liability protection as with an LLC. If you're buying a property cash in an LLC or refinancing, you're going to be working with different kinds of loans. You have your conventional residential loan, which is in your personal name. Key advantage: the best rates and terms for maximum cash flow. The risk is the high personal liability and the due on sale problem. Then you have commercial loans, which are made to the LLC. The advantage is the title is in the LLC's name directly, so no duty on sale issues. The risk is they have higher interest rates, shorter loan terms like 15 to 25 years, and typically have variable rates. And finally, you have DSCR loans. These are becoming super popular with investors. DSCR stands for Debt Service Coverage Ratio. The best thing is the lender is not concerned with your personal W-2 income. They are only concerned with the rental income of the property. Is the rent going to pay for the mortgage? This is fantastic for self-employed investors or for growing a portfolio quickly. The downside is the rates are slightly higher than standard conventional loans, so the choice is a trade-off. You're essentially paying a higher monthly payment as a premium for the legal protection of the LLC. As you grow and buy more properties, a new problem crops up: cross-contamination. If you have multiple properties in one LLC, a lawsuit against one property could put all of them at risk. The classic response is to create one standalone LLC per property. You get optimum liability separation, but the administrative burden is a nightmare. Consider a separate filing, a separate annual fee, a separate tax return, and a separate registered agent per property. It gets expensive and complicated in a hurry. A more recent option is the Series LLC, or SLLC. Think of a master LLC that can hold multiple legally separate cells or series within it. Each series can hold one property, and a lawsuit against one series is insulated. It can't touch the assets in the other series. The advantage is huge cost and administrative savings. You file one annual report for the whole master LLC. The disadvantage is that it's not recognized in every state, and the law supporting it is still relatively new, so there's a little legal uncertainty in some places. Now, the smartest thing you can do, regardless of which structure you choose, is to implement a dual defense system. Don't just keep all your eggs in one basket. Use both the legal protection of an LLC and solid insurance. Your first line of defense is umbrella insurance. You have your normal landlord policy, but you have an umbrella policy over it. It kicks in when a claim exceeds the limits of your underlying policy. We're talking about an extra $1 million or more of coverage for those catastrophic cases. Your second layer is the LLC itself. In the event a lawsuit is so large that it penetrates your umbrella insurance coverage, the LLC acts as the final backstop. The plaintiff can only go after the assets of the LLC, protecting your personal wealth from that excess liability. One very critical note: if you transfer a property to an LLC, you must call your insurance agent and modify your policy immediately. A personal insurance policy will not typically cover a property after it's in an LLC, and you could be completely uninsured. In spite of all of the above, is personal ownership ever the right choice? Yes, in certain limited low-exposure situations. If you have a single rental unit where you do not have much equity built up and your own net worth outside of the property is not too high, the cost savings and availability of that great residential loan might be worth the risk, at least for the time being. If you really optimize your insurance coverage with a huge umbrella policy, you might feel that you have enough financial protection against most claims to make it worth skipping the LLC fees and paperwork. Finally, if you're a brand new investor who values simplicity and less paperwork above all else, and you're willing to accept the risk, then personal ownership is the simplest way to get started. So to recap everything, here is your final decision checklist. First, calculate your risk and net worth. Add up all of your personal wealth, investments, savings, home equity. If that amount is significant, the cost of an LLC is no longer an option. It's a necessary insurance premium you need to pay. Second, review your financing strategy. Do you need a conventional loan for your cash flow? If that is the case, you will need to either have a plan to deal with the due on sale clause, or you will need to be willing to pay more for a commercial or DSCR loan from the onset. Third, crunch the administrative costs. Look up your state's LLC fees, factor in a registered agent, and budget for it. Know what you're getting yourself into. Fourth, establish that double defense. In any case, budget for a high-limit umbrella insurance policy. It is not an either-or with an LLC. They are best used together. And fifth, if you do choose the LLC, commit to compliance. You have to be all in. Separate bank accounts, careful records, and prompt payment of your state fees. Otherwise, you've wasted time and money, and you're once again personally exposed. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.